Chapter 2, What is Bitcoin Halving? To understand the future of crypto, you must first understand Bitcoin. And to truly understand Bitcoin, there's one event that stands above all: the halving. Bitcoin isn't printed by governments. It doesn't flow from central banks. It's created by a process called mining, powered by computers solving complex puzzles. But there's a catch one that changes everything. From the beginning, Bitcoin had a rule. There will only ever be 21 million Bitcoins. That's it. A hard limit locked into the code itself. No one can create more, not even Satoshi Nakamoto, the mysterious creator who launched Bitcoin in January 2009. So how does Bitcoin control its supply? What stops it from flooding the market and losing its value? Enter the halving. Over time, as more Bitcoins are mined, the system automatically cuts the mining rewards in half. This means miners get fewer coins for their work. Why? Because if new coins kept flooding the market, Bitcoin's value could crash. The halving is the solution, a built-in shock absorber. It slows down supply, increases scarcity, and keeps the economic balance. But to truly understand how this works, we need to look deeper into the heart of Bitcoin's mining system, its reward mechanism, and the chain reaction it sets off every 4 years. Chapter 3, The Halving begins. The first test came in November 2012. Bitcoin had been quietly circulating among cryptographers, gamers, and tech enthusiasts. Then, like clockwork, it happened. The very first halving. Until that moment, miners received 50 Bitcoins for every block they solved. But overnight, the reward was slashed to 25. Some called it a disaster. Others held their breath. But something strange happened. Instead of crashing, the market adapted. Bitcoin's price held steady, then began to rise. Why? Because the rules of economics had been rewritten. With fewer new coins entering the market, scarcity increased, and scarcity fuels demand. The second halving struck in July 2016. Rewards dropped again from 25 to 12.5 Bitcoins per block. Once more, the same pattern repeated. Speculators, investors, and curious newcomers flooded in. Prices surged, mining became more competitive, and Bitcoin's legend grew. Then came the third halving. May 2020. The world was in chaos from a global pandemic. But the Bitcoin network moved forward without missing a beat. Rewards dropped to 6.25 Bitcoins per block. And once again, a historic bull run followed. By now, it was clear. Each halving didn't just reduce supply. It was a global economic signal. A reminder that Bitcoin follows no central authority, no human decision. It is governed by code and time. Look at the chart. Bitcoin's total supply rises fast in the early years. But by 2024, over 93% of all Bitcoins will have been mined. By 2040, it will be nearly 100%. Each halving brings us closer to the finish line, and each one tightens the grip of digital scarcity. Chapter 4, The Halving Effect. When scarcity meets speculation. 3 halvings, 3 massive shifts, and one undeniable pattern. Every time Bitcoin's supply was slashed in half, its price didn't just react, it exploded. The first halving took place in December 2012. At the time, a single Bitcoin traded for about $13. But just 11 months later, by November 2013, Bitcoin hit 1,161, a nearly 94%. The world took notice. Then came the second halving in July 2016. Bitcoin's price at the time hovered around $640. Again, it seemed quiet at first. But 18 months later, the crypto market witnessed a storm. Bitcoin surged to nearly 19,600, a 30x jump from the halving price. Coincidence? Maybe once, but twice? Then came the third halving, the most recent and perhaps the most dramatic. In May 2020, Bitcoin was trading around 9,667. And once again, the countdown began. Roughly 11 months later, in April 2021, Bitcoin smashed through 64,700, marking a 7x increase. Each halving had its rhythm. Each one followed a lag, a quiet buildup before the rocket took off. As of May 2021, that rally was still in motion. No one could say when or where it would end. But one thing was clear: Bitcoin halvings create waves. not just in the blockchain, but across the world's financial systems. The next halving? It's already on the calendar. Investors are watching. The question isn't if the price will rise. It's when and how much. Chapter 5, The Halving Cycle, a rhythm of boom and pullback. By now, a clear pattern had emerged. With each halving, Bitcoin didn't just rise. It surged over 12 to 18 months, then eventually faced a steep correction. Not chaos, not collapse, just a cycle. This rhythm of boom and pullback became one of Bitcoin's most talked about mysteries, a financial heartbeat repeating every 4 years. Let's go back to the first halving in December 2012. Bitcoin was worth just $13 at the time, a digital curiosity ignored by most of the world. But within 11 months, something incredible happened. By November 2013, Bitcoin's price had rocketed to $161. It was the moment the world could no longer look away. And then, the pullback began. Bitcoin dropped sharply, settling into a new range. Higher than before, but far below its peak. On the chart, it looked like a mountain peak. But to seasoned investors, it was a signal. This is the cycle. This is the game. Understanding this pattern became key. If Bitcoin halvings repeat every 4 years, and if the price consistently follows the same rise and fall motion, then maybe this wasn't chaos at all. It was structure. A new kind of investor emerged. One who studied past halvings, tracked timelines, and built long-term strategies not on hype, but on history.
Chapter 7, The Giants Enter Institutions in the Crypto Market. For years, the crypto market was seen as the Wild West. A place for tech geeks, risk-takers, and early believers. But something has changed. The giants have arrived. Institutional investors, massive funds, asset managers, banks, and even governments are now stepping into the world of digital assets. But who exactly are they? In traditional finance, institutional investors are large entities that pool money from clients or stakeholders to make large-scale investments. They don't just trade based on emotion. They operate with long-term strategy, risk management, and billions of dollars in capital. And when they move, markets notice. Their presence in the crypto market brings both legitimacy and stability. Unlike retail investors who chase trends, institutions often take a conservative, data-driven approach. In fact, many retail investors now track institutional activity, using their moves as signals for their own strategies. As global regulations mature and infrastructure improves, international institutions are entering the crypto space like never before. They're no longer just watching from the sidelines. They're building, they're buying, they're believing, and when institutional money flows in, it doesn't just move the market, it reshapes it. Chapter 8, The Institutional Titan Grayscale and the Rise of Crypto Funds. If there's one name that echoes loudly across the halls of institutional crypto investing, it's Grayscale. Founded in 2013, Grayscale quickly became a pioneer in digital asset investment. Based in the United States, the firm launched the first ever regulated investment vehicle that allowed institutions to gain exposure to Bitcoin without the hassle of holding it directly. Their flagship product, the Grayscale Bitcoin Trust, GBTC, opened the floodgates. Suddenly, hedge funds, pensions, and asset managers could allocate capital to Bitcoin just as easily as buying a stock. By October 2020, Grayscale had made history again, registering with the U.S. Securities and Exchange Commission (SEC), and becoming the first digital asset fund to report directly to regulators. This wasn't just a fund, it was a signal, a green light for Wall Street. And Grayscale didn't stop at Bitcoin. Their portfolio expanded to include Ethereum, Litecoin, and more, offering diversified crypto exposure for traditional investors. Even more powerful was their transparency. Grayscale regularly publishes its crypto holdings, showing exactly how many coins they own across each fund, while OTC over-the-counter trades made through Grayscale don't always impact market prices directly. They reflect sentiment from the world's biggest players. When Grayscale buys, the market listens. Chapter 9, Reading the Portfolio: What Grayscale is Really Telling the Market. When Grayscale buys, the world watches. But what exactly is Grayscale buying? And how much? Unlike shadowy hedge funds or anonymous whales, Grayscale doesn't hide. They publicly disclose their holdings coin by coin, fund by fund. At the top of the list is, of course, Bitcoin BTC. Hundreds of thousands of coins under management. But that's just the beginning. Their portfolio stretches across the crypto landscape. Ethereum ETH, Litecoin Lieutenant Kernel, Bitcoin Cash BCH, Chainlink. Link, Filecoin Phil. Each fund tracked, reported, and updated regularly. These holdings don't just represent investment. They represent institutional confidence. And then there's the GBTC Premium, a unique phenomenon in the crypto world. You see, investors who buy into the Grayscale Bitcoin Trust (GBTC) can't sell their shares immediately. There's a 6-month lock-up period. When demand surges and supply is limited, a premium appears, where GBTC trades above the actual value of the Bitcoin it holds. But if sentiment turns, the premium can flip into a discount. It's a powerful signal, a window into institutional psychology. Sites like Byte.com offer real-time data on Grayscale's entire portfolio. Investors use it to gauge market trends, track which coins are being accumulated, and even anticipate price movements. Grayscale isn't just a fund. It's a barometer, a mirror reflecting how the biggest players in the game see the market. And when that mirror starts to shift, it may just be time to adjust your own strategy. Chapter 10, Cracking the Code: How to Track Institutional Bitcoin Buys. Institutions don't buy their Bitcoin on public exchanges. Like the average investor, they move quietly. They trade over-the-counter OTC away from the spotlight. That means it's almost impossible to see exactly how much they buy, or at what price. But impossible? Not quite. A few tools exist that give us a peek behind the curtain. One of them is the site Bitcoin Treasuries. Net. It tracks known Bitcoin holdings of publicly disclosed institutional investors, companies, funds, and even governments. It tells you who owns what, how many coins they hold, and what those holdings are worth right now. Another method is to follow the estimated entry prices. By comparing price charts with inflows into institutional wallets, analysts attempt to pinpoint the average buying price of large players. Of course, this data isn't perfect. Much of it is based on estimations, not exact records. But when used carefully, it becomes a powerful tool. By watching the value of their portfolios over time, we can gauge when institutions are accumulating, and when they might be backing away. Because when the whales move, they leave ripples, even in the deep. Chapter 11, The Corporate Vaults: Who Owns the Bitcoin? It's no longer just hedge funds and private investors. Today, some of the world's most powerful public companies hold Bitcoin on their balance sheets, and they're not shy about it. At the top of the list stands MicroStrategy. Led by CEO Michael Saylor, the company stunned the financial world in 2020 by making Bitcoin its primary treasury reserve asset. They didn't stop at one buy. They kept going, accumulating over 114,000 BTC, worth billions. Then came Tesla. In early 2021, Elon Musk made headlines when Tesla announced it had purchased over 40,000 BTC. The move sent shockwaves through both the crypto and traditional finance world. If the world's most valuable automaker believed in Bitcoin, what was stopping others? They weren't alone. From Galaxy Digital to Voyager, Block, formerly Square, and even firms like Marathon, companies began quietly building digital vaults of their own. And it didn't stop at corporations. ETFs, hedge funds, and even governments have entered the game. Their combined holdings now account for hundreds of thousands of coins. Websites like Buy Bitcoin Worldwide, Com Treasuries, track these holdings in real time, showing not only who owns what, but how much their portfolios are worth today. This data gives retail investors a powerful insight. If the big players are holding, maybe there's a reason. If they're buying more, maybe it's time to pay attention. Because in a market driven by confidence and scarcity, who holds the Bitcoin can sometimes matter as much as what it's worth.
Chapter 12. Can you really see what others are trading? Welcome to the world of on-chain data. In traditional finance, you never really know who's buying what. The trades are private, hidden behind institutions, exchanges, and market makers. But in crypto, everything is visible. Every single transaction ever made with Bitcoin, every buy, every sell, every transfer, is permanently recorded on the blockchain. This public record is called on-chain data. It's raw, transparent, and unstoppable. Anyone can access it. Anyone can analyze it. And if you know how to read it, it becomes a crystal ball for future market movements. One of the most popular uses of on-chain data is tracking whale activity. In the stock market, large investors are called whales. Because of their size and influence, crypto adopted the same term. Whales are addresses that hold massive amounts of coins. When they move their funds, the market watches. Why? Because one whale can tilt the balance of supply and demand. On-chain analysts use blockchain explorers and data aggregators to monitor whale wallets, trace transactions, and identify sudden inflows or outflows. These movements often signal big changes ahead. By combining on-chain data with market trends, investors can gain an edge spotting accumulation zones, exit points, or even preparing for volatility before it hits. The blockchain doesn't lie. It remembers everything. And in this transparent system, the smart money leaves footprints. Chapter 13. Watching the Whales. How big wallets move the market. In the crypto ocean, whales don't just swim silently. They make waves. Unlike retail investors, whales hold tens of thousands sometimes, hundreds of thousands of coins. And when they move, the market feels it. In traditional finance, large trades are often hidden behind layers of reporting and delayed disclosures. But in the crypto world, the blockchain lays it all bare. Every transaction, every wallet, every movement. And that's where things get interesting. Some on-chain tools now offer real-time lists of the top 100 richest Bitcoin wallets. By tracking these addresses, analysts can see whether whales are accumulating, holding, or selling. These insights often hint at what's coming next. For example, if whale wallet balances are rising while prices are falling, it may signal long-term confidence a quiet accumulation phase. But if balances suddenly drop while prices are rising, it could mean whales are starting to take profits. And that's not all. Even if whales aren't actively trading, the mere knowledge of their holdings creates psychological pressure on the market. Investors start to ask, what do they know that we don't? In a space where news breaks fast and fear spreads faster, whale watching has become an essential skill for anyone trying to stay ahead. Because sometimes the smartest move is just following the biggest fish. Chapter 14, Beyond Bitcoin, using on-chain data for altcoins. Bitcoin may be the king, but the crypto world is a vast empire full of altcoins, each with their own rules, teams, and ecosystems. Can on-chain data still help? Absolutely. Altcoins like Ethereum, Solana, and Clayton don't just float in cyberspace. They operate through foundations, issue white papers, and follow structured roadmaps. Many of them also release token distribution charts and project updates, providing a deeper look into how the coin is actually being used. But the most revealing data still lies on-chain. By analyzing the wallets that hold the largest portions of a given altcoin, investors can identify the presence of foundations, insiders, or whale partners. For example, if a single wallet holds a massive amount of tokens, it might belong to a treasury or a long-term investor. If smaller wallets suddenly increase their holdings, it could signal new partnerships, OTC deals, or early interest. Let's take Clayton Clay as an example. By analyzing the distribution of token holders, we can estimate how decentralized it is, how concentrated the holdings are, and whether there's ongoing accumulation or selling pressure. Even if we don't know the identity behind each address, the behavior speaks volumes. Increasing wallet activity may suggest network growth. Decreasing holdings might indicate profit-taking or loss of faith. On-chain data for altcoins is like X-ray vision. It doesn't just show you what's happening, it shows you why. And in a world full of hype and speculation, that kind of insight is pure gold. Chapter 15, the final clue. Tracking exchange inflows to read the market's pulse. You can track wallets, you can follow whales, but sometimes the biggest signals come from one simple question. Are coins moving into exchanges or out? This is where on-chain data becomes truly powerful, and platforms like CryptoQuant are leading the charge. They provide a wide array of blockchain analytics, but one of the most telling indicators is the exchange inflow metric. Here's the logic. When large amounts of Bitcoin flow into exchanges, it often means investors are preparing to sell. When coins leave exchanges and head toward cold wallets, that usually signals long-term holding or accumulation. It's a heartbeat, a pulse, a way to gauge what the market is thinking before it acts. Of course, some assets might sit safely in private wallets or OTC holdings, but when someone wants to turn crypto into cash, they almost always pass through an exchange. That's why exchange data is so valuable. It tells us when pressure is building. It reveals when the crowd is nervous, or when it's getting ready to make a move. By watching these flows in real time, you gain an edge, a glimpse of sentiment, a whisper of the next storm or the calm before it. Because in crypto, the truth is never hidden. It's just waiting on-chain. Chapter 16, Signals from the Blockchain. Reading market moves before they happen. Imagine this. You see a sudden surge in Bitcoin inflows to exchanges. Thousands of coins all heading in. What does it mean? To seasoned investors, it's a red flag. When Bitcoin is sent into exchanges, it's often a sign that holders are preparing to sell. Volatility may be just around the corner. On the flip side, when large amounts of Bitcoin leave exchanges, it usually means whales are moving coins to cold wallets for long-term holding. Confidence, accumulation, a bullish signal. It's a simple idea, but incredibly powerful. Let's break it down. More coins entering exchanges, possible selling pressure. More coins exiting exchanges, possible buying pressure or accumulation. These movements, visible through platforms like CryptoQuant, offer a real-time window into market sentiment. The chart doesn't lie. In fact, when you overlay Bitcoin's price chart with net exchange inflows, you'll often find something stunning. Price drops frequently follow inflow spikes. This is why on-chain data has become one of the most valuable weapons in the modern investor's arsenal. Not just speculation, not just news headlines, but verifiable signals from the blockchain itself. And now that you've seen how to read them, the only question left is this: will you listen?
Chapter 17: Futures, Fear, and the Power of Leverage. In crypto, the markets never sleep, and neither do the traders. Welcome to the world of futures, a battlefield where leverage amplifies both greed and fear. Unlike the spot market, where you buy and hold real assets, the futures market allows traders to bet on price direction, without ever touching the actual coin. Bullish? Go long? Bearish? Go short, win big, or lose it all. Futures are nothing new in traditional finance. They're used to hedge risks, lock in prices, and speculate on movements. But in crypto, the game is different. Here, futures are driven by 247 volatility, lightning-fast sentiment swings, and the rise of retail-friendly platforms, like BitMEX, Bybit, and Binance Futures. Unlike legacy futures markets like CME, which cater to institutions, crypto-native platforms allow anyone anywhere to enter the fray, with little more than a phone and a few clicks, and with leverage often reaching 20x or even 100x. Every candle becomes a high-stakes decision. That's why futures data is so important. By tracking open interest, funding rates, and the long-short ratio, investors can sense the crowd's positioning, and when the herd might get caught off guard. Because when too many are long, a small drop can trigger a cascade of liquidations, and when the shorts pile in too deep, a short squeeze can launch a surprise rally. In this world, it's not just about where the price is going, but who's betting what, and how much pain they can survive. Chapter 18: When the Tail Wags the Dog. Futures volume and market distortion. Look closely at the charts. In early 2021, both retail and institutional interest in Bitcoin futures exploded. Volumes on major platforms Binance, CME, Bybit soared. But the real story wasn't just in the numbers, it was in the leverage. Unlike traditional assets, crypto futures often allow traders to borrow 10x, 20x, even 100x their capital. This means small moves in price can lead to massive gains or catastrophic losses, and when everyone's playing with borrowed money, the stakes get dangerously high. Here's what happens when futures volume surges. A growing portion of market activity becomes driven by short-term speculation, not long-term conviction. At times like this, a strange phenomenon emerges, called wag the dog. In theory, futures are supposed to reflect the spot market, but when leveraged futures trading grows too large, it can drive the spot price itself, distorting the natural flow of the market. Sudden crashes, they often begin with liquidations in the futures market. Unexpected rallies, short squeezes fueled by over-leveraged bears. This is why understanding futures volume isn't optional, it's essential. When futures volume spikes, you're not just watching a chart anymore, you're watching a storm build, and you'd better know which way the wind is blowing. Chapter 19: Longs, Shorts, and the Battle of Belief. In the high-stakes arena of crypto futures, there are two sides to every trade, the longs and the shorts. Longs are betting on the price to rise. Shorts, they're rooting for the fall. It's more than just a market mechanism. It's a psychological battlefield. Thanks to leverage, traders can magnify their bets, sometimes by 20x, 50x, or even 100x. This means even the smallest move in price can wipe out entire positions in seconds. That's why the long-short ratio matters. It's not just a number, it's a window into how the market feels. If longs dominate, it means most traders expect the price to go up. If shorts are piling in, fear may be spreading. And if the ratio becomes too lopsided in either direction, the market tends to punish that side. Too many longs, a sudden drop can trigger mass liquidations. Too many shorts, a rally can spark a brutal short squeeze. By monitoring this ratio, investors can detect hidden pressure building beneath the surface, and position themselves before the next wave hits. Because in crypto, what people believe often becomes what the market does. Chapter 20: Beyond the Charts: Turning Data into Strategy. By now, you've seen how deep the rabbit hole goes, from halving cycles to whale wallets, from exchange inflows to futures leverage, from long-short ratios to market psychology. Crypto isn't just numbers on a screen, it's a battlefield of belief, data, and timing. We've learned that when futures volume surges, the tail can wag the dog, that when longs or shorts dominate, liquidations aren't just possible, they're inevitable. We've seen how exchange flows can foreshadow price swings, and how wallet activity can whisper the next big move. But knowledge is only power if you act on it. Understanding these signals gives you an edge, but turning that edge into success, that requires discipline, patience, and strategy. Use long-short ratios to sense fear and greed. Watch on-chain flows to spot silent accumulation. Track whale movements not to follow blindly, but to understand how the market breathes. In this digital age, the truth is open. The data is out there for everyone. The question is, will you just watch the waves or learn to surf them? This is not just a market, it's a living, evolving system of signals and stories. And now, you know how to read them. Welcome to the future of crypto investing. Let the data lead.